welcome back, traders and investors, to Pre-Market Prep. I'm Spencer Israel along with Dennis Dick, and we are on the line with Rob Friesen. He is the president of Bright Trading. Rob, how are you doing this morning?
Great. Thank you for having me on
Good.
the show.
Thank you for coming on. I know Dennis was going to ask you some questions, so I'm going to let Dennis take it away from here for now, and I'll pop in if I have anything.
Rob,
Okay.
first of all, just give us the background here on Bright Trading, like how the company got started, and obviously your role here at Bright Trading.
It started in 1992 with some friends that were, involved in blackjack for many years, and decided to go into the markets. And yeah, a lot of history there, and they did very, very well at blackjack. But anyway, they
Bob, right?
decided to, yeah, Bob Bright and Eddie Franco were the co-founders of Bright Trading, and Bob had actually retired uh, and was kind of came out of retirement to start Bright Trading, so that's how that worked. But yeah, it's a company that was built by traders for traders. I mean, that's what we've always touted, is that it's kind of a homegrown family business that way, and it was built by traders for traders. So it's a
And what's the
proprietary
Rob
trading
Friesen
firm.
and Rob, what's the Rob Friesen background? Because I know you started with the company right around the same time. I think you started in '98, didn't you, with Bright? Because I started in '99. Were you '98? Were you the year before me?
Yeah, I can remember exactly January 10th, 98.
What was
And
your background before Bright Trading? Because I don't even know if I know the Rob Friesen background.
um, just a retail trader for 6 years before I came to Bright. The reason I wanted to join Bright was at that time they were advertising no ticket charges, where I was paying ticket charges. The commissions were definitely lower at the time than I was paying, and access to more capital. So it was just a very attractive situation, and I packed my bags and flew to Las Vegas and knocked on the door and said, I'm here. So
And then you ran the British Columbia office and you still run the British Columbia office and kind of the whole company now. But how many traders at the peak did you have out there in your BC office?
in my particular office, 36 I had at the peak, just in my office in Langley. And yeah, a lot of people traveled in to get some training as well. So really got to know a lot of the traders in the firm at that time, and it was great because got to see, what people were dealing with on a wide spectrum, and working with traders is a great way to, you know, tighten yourself up in terms of your own discipline and rules and goal setting and stuff. So it really benefits to be adding value to other people's lives. You get a lot in return as well.
I miss the trading office. That's one thing, that's, obviously as the internet evolved, everybody started going home. And, at Bright Trading, we, at one time, I believe, had as many as 40 offices across the US and Canada. And now, we're down to, significantly less than that because everybody does it from home here now. So that's, one thing that's the downside, because there was a lot of ideas always bouncing around. And obviously, I trade in the Detroit office of Bright Trading for the better part of 12 years as well. And just the ideas that come out of the office being in the same room as the traders really is a benefit there. But you still have a lot of your traders still linked in through Skype, correct?
Yeah, we do a conference. We do a webinar every day. We try to you know educate a bit on what's going on. You need to be connected for sure. It's tough to be an island by yourself, just sitting there. And I mean, you come up with crazy stuff when you're on your own island, right? Well, what movie was that? Tom Hanks. Whenever
Yeah,
you start
Castaway.
you
That's
you you start talking to coconuts and stuff,
Talking
right?
to talking to volleyball, yeah. Nothing wrong with that.
nothing wrong with that. So
So yeah.
let's jump into the markets here. So that's a little bit of the background, but let's jump into the markets and talk. I know you're a big fan of seasonality here. We're coming into the end of the year. You get some tax loss selling towards the end of the year. Sometimes some of your laggers underperform, and then in January sometimes the story changes. So can you just tell us a little bit, potentially about seasonality and the January effect?
Yeah, first I'll say that we have noticed a very significant pattern over the last couple years, which used to be different. Everybody referred to window dressing at the end of the month, but have you not noticed that the last day of the month is suffers from selling pressure, and the opposite of what you would expect in so sort of a window dressing environment. So let's take that particular day out of the seasonality window. Seasonality refers to 401k money and payroll deposits. And we at Bright Trading, we use like last 3 days of the month, the first of the two of the new month. Some other people like to use the last five and the first two or three. There's nothing wrong with that. It really covers that whole window. You also have a mid-month payroll deposit environment too that you have to be aware of. So there can be a little swell up in the middle of the month, and there can be a fairly reasonable swell in the last 3 to 5 days of the month and the first 2 to 3 of the new month. Well, if you've heard about the Santa Claus rally, I mean, it really overlaps, seasonality window for December anyway. Like, I think the Santa Claus rally is the last 5 days of the month and the first two of the new month. So we don't have to get a Santa Claus rally, and if you don't, then it usually precedes bear markets. But reminder about the presidential cycle as well. Reminder about kind of how flat we've been this year and down a bit. So
What is
there's
the presidential cycle there, Rob? Just for our listeners there that probably aren't familiar with that term. What is that?
well,
Market?
I mean, it depends whether there's a re-election option viable versus somebody new coming in from either party. But generally speaking, it means that there's things done economically. There's stimulus. There's probably looser spending habits in an effort to to get elected. And in this case, it would still apply to, I believe, the Democratic Party would want to see their legacy perpetuated. So I think it kind of applies the same way. But it just means that there is this swell in the last 2 years of the presidential cycle, and we're going into the last year next year. So you could easily have a reasonably up market on that basis. But back to the Santa Claus rally here. If you don't get one, it could be a bad year, or it could be the start of a bear market or whatever. So we're not out of the woods. If people think, well, the economy is going well, the Feds have raised rates, and expect to continue to raise rates, it doesn't mean we're out of the woods. First of all, how good is the Fed at predicting the future? You can look at the past track record and see that they're just like anybody else. They do their best, but they do control monetary policy, and so their decisions are going to have ramifications. Much of the decisions surrounding the Fed do move markets. I agree with don't fight the Fed. So they're on a interest rate normalization path. How aggressive, we don't know, but it's going to have ramifications, and it may not be, as expected. You could have a pullback in the market that could be quite significant. So I'm not predicting that. I'm just saying you have to be aware of multiple scenarios. We could have a nice last year of the presidential cycle rally. We could have a surprise along the way in terms of a big correction, or both. We could go down and then come back up too, right?
And
So
that's what trading is all about, is like having that contingency plan to abort mission when obviously your original thesis is wrong. And that's something you guys stress at Bright Trading as well, as the discipline to admit when you're on the wrong side of the trade, because we're all going to be on the wrong side of the trade, especially the amount that we trade at Bright Trading. We're going to be on the wrong side of the trade probably every day in some individual issues. So it's
yeah.
about being able to identify that and limit the downside when you are on the wrong side of the trade, correct?
Well, let's talk about something that's right in front of us. Okay, so the Santa Claus rally should start on Wednesday. This week is bullish historically. That kind of carries over a little bit into next week, but this is certainly a better week for if you're going to be bullish than even next week is. But here we are. We've got a gap fill potentially, right? So if the spider is pushing up to break yesterday's high, then it might trade into that gap. So that might be, an opportunity for somebody to create if-then statements and say, if we cross yesterday's high, I'm going to, obviously protect my downside, but I'm going to take a opportunity for that gap fill, right? That was the gap from Thursday to Friday,
Yeah.
right?
Mhm.
And you trade gaps a lot, I know, Dennis.
We like the gap fill. We always say price has memory, and when you have a gap, there's not a lot of memory in there. So a stock can move through a gap area with a relative ease compared to other areas where it's traded for a long time in that area.
Yeah, so I mean, we went up 3 days and came down in 2 days. So there's tremendous movement potentially, but we also got a problem in how much volume is around this week, how many players. So there's two problems with that. One, you can actually move a lot with very little volume, or two, you can do nothing. Like people are expecting follow through, and there just isn't enough players to create it, right?
Right.
So you've got, there's always two sides of the coin, and that's what trading's about is running scenarios and being prepared for either one, having even the stocks and sectors that you might trade with that. Certainly, in oil, people should be setting scenarios because the fundamentals on the whole industry aren't really going to change quickly. I mean, it looks like 2 to 3 years of excess or even longer. So the fundamentals are there, but you get oversold conditions. You get short covering rallies. You get speculation rallies. You get. I mean, normally in December is a great time to consider going long oil and energy. Historically, it's one of the sectors that you look at. So it's beaten down and so on. Yes, so the fundamentals haven't changed, but you can still experience short-term rallies. So you need to set your markers on your trades and say, this particular group, I'm going to go long if this happens, and these particular stocks show the best odds of follow through on short covering rally or relative strength reversals or whatever. So yeah, we're in exciting times. To have this much movement recently in December like this, and especially to the downside ahead of the Santa Claus rally, is an opportunity for sure. So there's going to be stocks that come back. Some of them have already suffered from tax loss selling, right? I mean, the institutions have their year end, most of them October 31st. That gets them out ahead of the public to some degree. Then the public finishes their tax loss selling, and then you got a lot of beaten down stuff to choose from, right?
So is
And
that
some
kind of the strategy, is to look for beaten down stuff this time of year, because often those stocks do tend to bounce back here come January?
Well, you've heard of the dogs of the Dow theory. That doesn't exactly work like it used to in the
Explain the
same
dogs of the
respect.
Dow theory just for our
Well,
listeners there, Rob, if you can.
just stuff that's Dow stocks that are down. I mean, we look at the Dow components compared to everything else nowadays, but the Dow components that were down, you would buy them at the end of this year or early in January, expecting them to bounce back from that sort of tax loss selling phenomena or whatever. But you can apply that to the broad market, and that is things that have really been oversold may have suffered from tax loss selling. It's the same thing as the pendulum swing. Did they get too far done, and can they bounce back from that? So with the 30-day rule of not being able to buy back your stocks that you just sold, if you want that tax advantage, then you buy them 30 days later. And that's really what the phenomenon is that people dump them and then they rebuy them back later,
Couple
or buy
questions.
similar products too.
Yeah, a couple questions coming out of the chat there from a couple of our guests there. Music Maker's asking, if we get into a bear market here, like a full-on bear market, which stocks other than commodities usually outperform the market. So if you start to get into a bear market scenario, which a lot of traders haven't seen, I mean, we've been in this relentless bull market here really since 2000 and the
You're
bottom
right.
of March 2009. So if, for whatever reason this market starts to turn, we start to get into a bear market, which sectors do you start to obviously, look at from a short perspective, and which stocks do you look at that might hold up relatively well to the market? Just talking sectors.
Well, the argument has always been for, dividend paying stocks that, tend to give you a nice sort of
Protection.
cushion. Yeah, a little bit. But I mean, at the same time, there's debate whether in a rising interest rate cycle, they're going to actually do that well because you might, look at more fixed income than risking in the market trying to get a dividend. But in the past, we have seen some benefit from the value stocks and the dividend-paying stocks during down cycles. Also, things that people have to have. You might cut out the discretionary spending. I know we got the 1% seems to be, driving the economy somehow, but a lot of discretionary spending could get cut, and yet the staple stuff. So let's say, for example, there's two ETFs. You have XLY, which is a sector spider for discretionary, and then you have XLP, which is the sector spider for consumer staples. If you just take a look at that ratio between the two, and I do recommend if people are looking at value versus growth or comparing, maybe regional banking to money-centered banking, maybe comparing the drillers to, energy in general. Look at your ratio charts. Take one ETF divided by the other, and the direction of that plot can be very helpful. So the seasonality of that plot, pair traders know this because they've always done this with pairs, but to do it when you're trying to look for ideas and comparing whether discretionary spending, is trumping, consumer staples, just take a ratio chart. Well, anyway, in a down cycle, you would expect maybe consumer staples to hold up better than discretionary.
And that's a
Right.
lot of your trading strategies at Bright Trading is, you guys put on one stock and short another stock against it, trying to stay market neutral in a lot of cases, correct?
Well, let's say, for example, that you had a number of energy stocks that maybe had better or higher beta than the market, or were pretty aggressive movers. You might buy Conoco, Chevron, and a few others, Royal Dutch or something like that, and short the XLE. They're all components of the XLE. XLE becomes your hedge, and the components you're long. And what you're really looking for, what your hypothesis is that you could backtest to prove as well, is that the stocks are going to outperform the hedge. The stocks are going to do better than the short that you have on. But that kind of insulates you from catastrophic risk if the whole market rolls over on you, the industry or sector rolls over on you. It kind of insulates you, and you're going for that, relative performance. You're trying to make money from that, and that's where Bright Trading has come in handy over the years for our traders, is that they get to use a lot of capital, and when you're using a lot of capital relative to maybe your own net worth, you want to hedge yourself. You want to kind of control the downside as much as possible, right? So and you want a scalable business. I mean, I see so many retail traders still point and click, just trade one stock here, one stock there, and that's really more of a hobby idea rather than a full on business. So you have to ask yourself, are what you're doing, can that translate into making a living? If you break down the expectancy of what you're actually trading, can that make you a living? You might find that it just can't. You need more capital, right? You need to take more trades. You need to, touch more tickers in a day. You need to maybe trade larger, which is a problem these days. What's the average trade size on New
Yeah.
York, for example? You're down to about 200, 205 shares is the average or something now.
A lot
Um,
different than we were trading in 1998, 1999. That's for sure.
Right. So it's hard to go deep. You almost have to go wide. You either have to bring on additional strategies. So you might have a mean reverting strategy for pairs or indexes. You might have a go with strategy for trend trading. You might have a looking for a gap fills everywhere, gap fill strategy. You might have a dividend strategy. You might have a seasonality strategy. It's better to add, if you're a hamburger flipping business like McDonald's, one day you go, why don't we add chicken? We don't have chicken on the menu. We're just flipping burgers. So they add chicken nuggets, then apple pie, soft ice cream, and even try pizza once in a while. Um, so you expand your business, right? You add more to it, and you can do it through strategies. You can do it through diversification. You can do it for touching more symbols. And this whole idea of relative value arbitrage or relative performance arbitrage is how career traders with access to capital really make a good living.
All right, we've been talking to Rob Friesen. He's the president of Bright Trading. Rob, thank you so much for coming on this morning. We did get some valuable insight, people in the chat. Appreciating your analysis, and we will talk to you again soon. So thanks for coming on.
Thanks for having me.
Thanks, Rob.